Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Our friends at Celsius are wheeling and dealing. Alani Nu is the new acquisition for Celsius. Now you've got two brands. If you're a shareholder in Celsius, you've got Celsius and you've got Alani Nu in there. That's why the stock is up 30% because there's some hope for growth again because the earnings themselves didn't really give you that hope. If you look at the one-year performance, there is a reason the stock is down 46%. It was trading near 100 bucks when the prospect of growth was still there, but then growth really started to slow down. The details emerged that Pepsi was kind of cutting back on the inventory orders from Celsius, and that is really what drives the revenue. So that was a concern for investors. And the stock was down close to 20 bucks just a couple of days ago before the announcement of this acquisition and before this earnings release that we see right here. Earnings themselves, not all that great. 3% growth on the revenue side for the full year, down 4% for Q4, so moving in the wrong direction. Net income negative for Q4 2024. There's a lawsuit settlement in there, so keep that in mind. That's what's driving the decrease year over year and for the full year as well. International growing at a decent clip, but still a very small part of this business. So Celsius is growing, but is it really? The reason the growth has slowed down is because they book their revenue when their distributors order from them, and those guys supply the retail market, and they really over-ordered when they saw the retail sales growing at a really rapid clip. So you got 21 to 22 more than a double, 22 to 23 more than a double. And during this period, Pepsi, their distributor, was ordering things hand over fist because they saw these retail sales. They were assuming that they would continue, and that growth really slowed down between 23 and 24. And Pepsi started to pull back, didn't need as much inventory as they used to, and they already had too much on store shelves. That's why you see the consolidated revenue grow really quickly in 22 and 23, maybe grow a bit too fast based on the assumption of that future growth that Pepsi had, and then really start to slow down now into Q3, into Q4. And the expectations are that Q1 25 isn't going to be all that impressive either. So when you look at these numbers, when you look at this year over year change in retail market share dollars, it looks very impressive. $489 million gain, which is better than Red Bull despite a much smaller market share. It looks impressive, but it's really because year over year the growth was there, but now as you move into the latter part of 24 into the early part of 25, that growth is really slowing down, which is going to impact their future revenue, their future orders from their distributor. And it's easy to say 24 grew a lot over 23 because the comparison was relatively easy. You started at an 8.2% market share. That's in that 23 baseline. That grew into 11.4% by the latter part of 23 and then started to grow beyond that. But now as you move into the latter part of 24, your market share in Q4 24 is actually lower than it was in Q3 23. So now Celsius is sort of moving in the wrong direction. That's why the stock was down as much as it was, because investors were worried about the lack of growth. And yes, this number looks really good, but the lack of growth into 25 onward was a bit concerning. So investors were asking, what are you going to do to spur on growth going forward? And I think Celsius management looked at this graph and sort of said, well, look at Alani Nu. These guys have 3.6% market share and are growing gangbusters. Year over year market share dollar change was 70% of what Celsius was, despite Celsius being, 3 times the size. So that's pretty impressive. So as you look at that growth rate, I think Celsius is kind of looking at their own main brand in Celsius, seeing the slowdown in growth and trying to find another avenue towards growth, and acquiring a growing brand will certainly do that. And that's especially true when you look at Celsius's balance sheet. They have nearly $1 billion of cash on the books. What else are they going to do with that money? Why not make an acquisition? Ghost was recently acquired by Keurig Dr. Pepper, so potentially there was some worries that some of these other smaller brands would get acquired by other competitors, and those market share gains would get harder to make if that were to happen, if they had the branding power of Monster or Red Bull or something like that. Celsius wanted to keep that from happening, made that acquisition, and now has close to 16% market share with the two brands, certainly the third biggest player, and now has the potential for growth as a combined entity, even if Celsius is starting to lose some of that luster on the growth side. There's also international sales. Those are going to drive growth as well for both Celsius and Alani Nu, especially if Celsius can help Alani Nu with international distribution because they are a bigger brand, have a bigger distributor in Pepsi. One of the things to keep in mind as well, and this was one of the questions asked on the earnings call, is that right now Celsius has Pepsi as their distribution partner. Alani Nu is partnered with a bunch of smaller distributors. What's going to happen in the future? They didn't have a clear answer for that, but I think in the long run, there'll be some sort of combination once the Alani Nu contracts expire on a go-forward basis. And yes, there's other products, other innovation, etc. that Celsius is working on. They talked about how, Q1 doesn't look all that amazing, but they're really excited about some of the innovations going into 25. I really didn't like the way they sort of avoided certain questions. Somebody would ask them, hey, what do you think 25 revenue is going to look like? And their answer would be, well, Q1's kind of weak, but we like the innovations going into the latter part of 25. Okay, so you're just not going to answer that question. I guess it is what it is. So from a growth perspective, it's the acquisition. I think that's really what they're hanging their hat on. They're acquiring a company that has $600 million in revenue in 2024, acquiring it at a 3x multiple on a revenue basis, a 12x multiple on an EBITDA basis. And that's similar to what Ghost was acquired for. I think they acquired 60% of Ghost for about $1 billion. Dr. Pepper did. For this acquisition, Celsius is diluting shareholders by about 9%. $500 million of this acquisition is via newly issued restricted shares that can't be sold for 2 years. They're also taking on $900 million in debt, and the rest is being paid for with cash on hand. So overall, doesn't put them in a precarious position from a balance sheet perspective. They'll still have $500 million in cash or so on the books, about a 1x net leverage ratio, significant cash flow generation going forward. And they've added this brand that's somewhat scaled already, that's $600 million in revenue, that between 22 and 24 grew at a 50% CAGR annually, that has a 20% plus EBITDA margin, that is free cash flow generative, that has these other side areas that they can expand into if Celsius wants to. It's still mostly energy drinks, but it's also pre-workout shakes, snacks, and other. One thing I wonder is that 2022 through 24 CAGR is 50%, but how much of that is front-loaded? When you look at the CAGR for Celsius, it's 47% or so between 22 and 24, but that includes 3% growth in 24 and 100% growth in 22 and 23. So that's kind of a different story than 50% annually every single year, and they don't really tell you that story right here. They do show you that on a retail market share gain basis in 24, Celsius was a 22% grower. Alani Nu was a 64% grower, which is much higher growth than any of these other players, and that's pretty good, but it doesn't mean that it translates to 64% growth or anything close to that. For example, this had 22% growth on a retail sale basis, but it only translated to 3% growth on an actual revenue basis. And it's during a time where they are actually losing market share. So year-over-year growth is probably moving in the wrong direction from a market share perspective, unless they can start gaining market share again. Alani Nu likely gaining market share with this type of growth, but it's hard to tell exactly where they're headed, how much they're gaining, and what the trend looks like. However, it's still a decent addition. It's still an interesting addition. It's one that's certainly going to get them back to growth. It's focused on a slightly different demographic, more female-focused, more colorful brand aesthetic. That sort of stuff matters. But at the end of the day, you're still acquiring a brand, and it's just a drink brand. How much lasting power does stuff like this have? You have to ask yourself that when you think about position sizing and valuation, because at the end of the day, yes, it's a growing category, 10% growth projected between 24 and 29 globally. There's a lot of room for international expansion, a lot of room for improving margins by combining two companies that are growing, that have slightly different brand aesthetics, and scaling those platforms to make them a bigger player in a category that's growing, especially in the sugar-free space where both of these companies are thriving. So you've got an interesting play here. The question becomes, what does the valuation look like? Disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. What have we got here? We've got a market cap of about $7.7 billion, an enterprise value of about $6.8 billion. So if you think about it that way, you're paying about a 5x multiple on an enterprise value basis based on the revenue for Celsius. without the dilution yet accounted for, without the revenue of Alani Nu in there. So Alani Nu cost about 3x the revenue. You're paying about 5x the revenue for Celsius. Are you comfortable with that? That's one question to ask yourself. Remember, there's 7.3 million preferred shares that Pepsi owns that aren't in here yet. That's for the Pepsi distribution deal. Acquisition dilution of about 9%. I'm building that into the fair value that I have here. We've got revenue growth. The deal won't come together until the latter part of 25. So about half of the revenue of Alani Nu is going to flow into the Celsius revenue for 25. You've got 30% growth in 25, about 30% growth, the other half of that revenue, plus some organic growth in 26. Margins are compressed in 25 because of the combination, some more combination costs in 26, and then margins kind of expand into that 15% range for a mature company. We've got about 6 to 5% growth for the next couple of years. If you want to play around with the spreadsheet, hit file, make a copy. There will be a link in the description down below. Free cash flow generation is pretty solid. You're talking about 1.5 billion in the next 5 years or so. Not a ton of stock-based compensation, maybe about 150 million within the next couple of years. I do have some buybacks, the rest of the money going towards paying down debt. Maybe you could do more buybacks. From a valuation perspective, 3 to 4% seems about right for something like this, with the upside of a combination like this, with the growth potential that it can offer. There's certainly some risk with the slowdown in Celsius, with the unknowns around the combination and how much Alani Nu can actually grow and hold on to that growth and hold on to that market expansion. I have 50% of the valuation at 3%, 50% of the valuation at 4%. If you want to play around with this, you certainly can. With that dilution, with a 10% target return, I get a fair value of about 28 bucks, about 13% below where it's trading at today. Seems reasonable to me. I like the acquisition. I feel like it's a good step for them. This cash on the books wasn't doing much for them, so might as well acquire a fast-growing competitor that could do something for your business when your one brand right now is struggling a bit. This other brand can offset that struggle a little bit. If you want to be more conservative, you can certainly go 3 to 4 to 5%. You get total returns anywhere from 1 to 11%. 12% or so. You get an expected return of about 8.8% with this 50-50 weighting. If you want to get a fair value range, it'd be anywhere from like 22 to 35 bucks, a price range between 34 to 60 bucks within the next couple of years. I think that's reasonable assumptions to make with these assumptions in place. If you feel like they're going to grow faster, or if you feel like their free cash flow margins can hit what Monster has in the 20% range, you're talking about a fair value in the $37 range, returns in that like 7 to 18% range. That's kind of the upside you would have here. That's where investors might really like this deal, because it allows them to have scale. It allows them to kind of generate a free cash flow margin that is going to be higher than they could on their own, get more free cash flow, buy back more shares, make further acquisitions, further investments in the business. But you have to account for the dilution that's in there, the potential for margin compression initially, the lack of growth in Celsius within the last 12 months or so. Is that going to change? That's my worry about this. Am I a buyer of Celsius right now? No. However, if it drops from here, because again, this might be one of those, we're going to take a bounce because something exciting happened and then investors sell off. However, there's also short interest in this company. If that becomes an issue, if short sellers start covering their positions, maybe this runs a little bit, but in the long run, I think a fair value somewhere in that like mid to high 20s range is really where I would start getting interested in this company. How about you? What do you think? Am I off on anything? Am I missing anything here? Are you a huge fan of Alani Nu in this acquisition, or are you more concerned about the slowdown in the Celsius brand and what that means for the stock as a whole? Let me know what you think down below. Leave a comment. Subscribe if you're new here, and as always, like the video.